Okay, good day and welcome to this next instalment from Smailes Goldie TV. My name's Ian Stocks, I'm the commercial manager at Smailes Goldie Group, and I'm going to be talking to Oliver Wilkes, our expert for the day.
Hi, Ian. My name's Oliver Wilkes. I'm a manager here at Smailes Goldie. I've been with Smailes Goldie since 2013 and I now work in the corporate finance team. I've been usually doing a lot of transactional work, but recently throughout this COVID crisis, I've been assisting a lot of clients with forecasts and a lot of the issues that COVID is kicking out at the minute for businesses. And I certainly think that directors' loan accounts is something that we've been talking with our clients with quite a lot.
Great. Okay, thanks, Oliver. Today we're here to talk about directors' loan accounts and to provide an understanding of its impacts on the director and the company. So we've chosen this subject as during the COVID crisis, some directors who had been paying themselves by dividend have had very little support from the government, and they've resorted to using their loan account to subsidise their income. So firstly, Oliver, it'd be good if you could just explain what a director's loan account is, please.
Yeah, sure. Well, a director's loan account is really exactly what it says on the tin. It's a record of the amount owed or owing to directors. I'm going to be focused more on what is an overdrawn account at the minute, which is where the director owes the company. And that's something we're probably seeing more of at the moment. And that sort of will show in the accounts of a company on the balance sheet as an asset to the business, as effectively that money is recoverable from the director. It comes about when a director has taken cash from the business without having been through the proper tax channels, shall we say. One thing to sort of point out at that point is that if you're a closed company, that is, you are less than 5 members, or you have directors who are also shareholders, that's important to bear in mind, because anything that your family members or associates also take out will also be classed as a director's loan account.
Oh, right, okay. So how would an overdrawn loan typically come about?
Well, really, as I said earlier, it's just basically wherever the company you've taken cash from the business, not through official taxation channels, shall we say. And that could be, for example, where you've simply taken cash from the account into your personal account, or where the business has incurred expenses on your behalf or perhaps a family member's behalf. The main thing here is it's not being taxed. And again, one thing to bear in mind here is if it's greater than £10,000, you will need some sort of shareholder approval as well on those loans before you take them out. So make sure that's considered as well.
Okay, so is it possible that cash taken as a loan won't be taxed?
No, unfortunately not. I'm afraid HMRC aren't in the business of allowing people to take cash from businesses without being taxed. And for those, you may have heard this before, but it's known as the Section 455 tax, which is taken from the section of the Corporation Tax Act that it comes from. And effectively what HMRC are saying with this rule is that if you have an overdrawn director's loan account at the year end of or period end of your business, normal financial reporting period, if that's not repaid within 9 months and 1 day of the year end, they will deem that as a dividend and effectively tax the business for that amount. So an effective rate of 32.5% will be applied to the loan outstanding at the year end, and that will be paid by the company, and that will be payable at that point. So that's 9 months and 1 day. And if it's not paid within that period, interest will accrue on that amount until it is paid to HMRC. Now, obviously, if you then repay that debt back to the company and the debt is effectively back to zero, then the company can reclaim that cash from HMRC that's paid over as the effective tax. However, the interest amount that was accruing will not be recoverable.
Oh, right, okay. So could a director just, repay the loan, then take it back again? So it was effectively, in a nil position and has redrawn the loan?
Again, I'm afraid not. This is something that HMRC have been pretty hot on, and in the past that used to be known as bed and breakfasting. And I'm afraid there are rules again to stop that. Otherwise, we could imagine a situation where there are plenty of directors in a company and everyone has a huge director's loan account paying no tax. Now, HMRC again wouldn't like that, and they certainly don't. So the rules in that regard are that if you have a loan of greater than £5,000, and then within 30 days of having repaid your loan, you take out another loan for £5,000, HMRC will apply the 32.5% again to the original loan amount, not the new loan amount. So what we like to say to clients is, don't get into the habit of recycling directors' loan accounts, because HMRC will see through that if they were to review directors' loan accounts, and they would apply the tax, which would be particularly detrimental. I mean, the other thing to consider here, again, in regards to the 30 days rule, is that even if you say 31 days, that's not guaranteed protection from this. HMRC will look at it, overall and say, hang on, this is clearly a recycling of the director's loan account. So, like I say, best not to get into the practice of recycling director's loan accounts.
Right. So, I mean, obviously, I can see that there's some particular consequences of doing this, but are the only consequences the ones that relate to your corporation tax charges?
No, there aren't. There are personal considerations to take into account here. So the first one being that if you are borrowing this money, quite often directors' loan accounts will have no interest implied because they're quite informal. HMRC take the opinion that, would the company have made that loan to a third party at that rate, and would the director be able to take it out of that from another unconnected third party, borrow the same amount on the same interest rate, i.e. zero, or perhaps a very low amount of interest. Now, they take the stance that no, that's not. So it's clearly a transaction between connected parties, and they apply what is their official interest rate. So when a loan has no or interest below the official interest rate, which is set by HMRC, they will apply the difference, and that will be taxed on you as a benefit in kind, which will go on your P11D or your self-assessment tax return.
Oh, right. Okay. So there are some quite big differences there. So,
yeah.
So
there's one of the points to raise on that, which is to say that if it is greater than £10,000, it'll be automatically considered a director's loan account as well, as a benefit in kind. Sorry.
Oh, right. So that would have to go on your P11D.
Absolutely. Yeah.
Ah, right. Okay. So other than repaying a loan, how could I clear an overdrawn director's loan?
Well, there are two options. Obviously, you could repay the amount back to the company, which might be an option. Say if you have borrowed for a genuine reason to sort of bridge some short-term cash flows from you personally, that you'll be able to repay that amount. However, if you are taking cash from the business, or the business is paying expenses on your behalf that you have no intention of repaying, obviously the best is to make sure that it goes through the official tax channel. So that could be either to treat it as salary and put it through payroll, or else we could vote a dividend against the director's loan account. But obviously make sure that sufficient reserves are there if you're voting official dividend for both yourself and the other members. Or else you could consider a deemed dividend through a write-off. If we're doing a write-off at that point, with it being a deemed dividend, there's class 1 NIC to bear in mind. So the importance of this is making sure that, obviously, if we're voting dividends to clear director's loan accounts, let's make sure that there's enough reserves there, and that really hammers home the point about making sure that you've got good, up-to-date financial information and management accounts.
Yeah, I completely get that. My next question, I suppose, relates to something I saw a fair bit when I used to work as a corporate banker. So if the company is struggling and becomes insolvent when there is an overdrawn director's loan in place, can you just talk me through exactly what happens there?
Yeah, sure. So insolvency now, as most people think, with a limited liability company, that gives you that limited liability protection as a shareholder. However, as a director, that's a separate role from being a shareholder. And if you have an overdrawn loan at that point, and you haven't repaid it at the point the business goes into liquidation or insolvency, then that will be a debt on you personally, and the administrator will effectively chase that debt from you. And if you can't repay it, there is the risk that if your personal assets don't cover the debt, that you could be made bankrupt. So it's something to make sure, certainly, if your business is in a difficult situation, which I'm sure a lot of businesses are at the minute, make sure that you're not running up with liability to yourself personally, and to seek advice.
Yeah, that's good advice, Ollie. I've seen that happen myself on a number of occasions to clients, and is well worth keeping a very, very close eye on. So finally, and we've talked a lot about overdrawn directors' loan accounts. So what happens, or what are the issues, if any, when a company owes money to the director, so i.e. when it's the
Yeah,
other
I
way
mean,
around.
it's something that can be allowed, and examples of this might be where you want to invest in the business on a temporary basis to help it get through perhaps some shortfalls in cash flow that we're all seeing at the minute. That's absolutely fine, it's allowed. The interest rate you then charge is up to you as well. But if you were to charge interest, that interest expense would be deductible tax for the company. But for you yourself as a director, any interest you receive from the company will be obviously taxed as income. And obviously, with it being a connected party, there are other rules around that, particularly with regards to reporting. So the company will have to do a quarterly report to HMRC through a form known as CT61. And that's effectively telling HMRC that yes, we have a loan from our director, we're paying him this much interest, but they will then deduct 20% of that income tax at source. And so the director will receive the net difference, which will then be sort of worked out through the tax return at the year end to sort of calculate the correct amount of interest, so tax to be charged on the interest.
All right, great. No, that's great. Many thanks for your insight, Oliver. So I think the main message from us is that if you particularly have an overdrawn director's loan account, please take advice. You'll see all of our details below. Please contact us. So that's it from us on this issue of SGTV. And no doubt we'll be coming back again with all the government announcements coming through thick and fast with some more instalments very shortly. Thank you for listening.